Investors often cite enhanced diversification as the primary reason for buying shares of foreign corporations. By spreading investments across nations, portfolio volatility can be reduced, mitigating potential losses during market declines, as international markets exhibit different behavior from the US. However, they can be highly profitable. To discover how to invest beyond the US and UK, watch this video till the end. But before we begin, remember to give this video a thumbs up and subscribe if you're new. ADRs, American Depository Receipts, are certificates issued by U.S. depository banks representing a specific number of shares, usually one share, of a foreign firm's stock. These ADRs trade on American stock exchanges just like domestic shares. For American investors, ADRs offer an opportunity to invest in foreign corporations that would otherwise be inaccessible. Simultaneously, foreign companies benefit by attracting American investors and capital without the complexities and costs of listing on U.S. stock exchanges. ADR prices often mirror the performance of the foreign stocks they represent, despite being traded in American markets. The currency of ADRs is the U.S. dollar, and they are held by U.S. financial institutions, frequently through foreign branches. Holding ADRs eliminates the need to deal with foreign currencies or worry about exchange rates, since they are valued, traded, and cleared through American settlement channels in dollars. However, U.S. banks must acquire shares from foreign exchanges before offering ADRs for domestic trading. ADRs are listed on the New York Stock Exchange or NASDAQ, although they can also be purchased off exchange, OTC. American banks require comprehensive financial data from overseas companies, making it easier for investors to assess a company's financial stability. Including international equities in your portfolio, which refers to owning stocks of businesses based outside your home country, offers several benefits. Firstly, it helps diversify your portfolio, reducing risk and allowing you to capitalize on economic growth in different economies. Diversification is crucial in investing as it lowers the chance of overall losses if one investment underperforms. By spreading your funds across numerous businesses, you increase the likelihood of maintaining stability. Additionally, investing internationally exposes your capital to economies with faster growth rates, potentially leading to increased profits. Favorable circumstances such as progressive leadership, tax incentives, access to resources, and industry-friendly regulations can accelerate growth in foreign markets. Some international equities meet the listing requirements of the New York Stock Exchange, NYSE, or NASDAQ and are traded on U.S. In summary, incorporating foreign stocks in your portfolio prevents your prospective market gains from being solely dependent on the U.S. dollar. However, it's important to assess your investing timeline and risk tolerance to determine an appropriate allocation for foreign investments in your portfolio. An open-end fund is a corporation that pulls money from multiple individuals and invests it in securities such as stocks, bonds, and short-term debt. The portfolio of a mutual fund comprises all its holdings. Investors purchase shares of the open-end fund, with each share representing a proportional ownership interest and the resulting revenue. It's important to acknowledge that all investments carry some level of risk, as the value of securities held by a fund can decrease. Dividends or interest payments can also fluctuate with changing market conditions. Past performance is not a definitive indicator of future returns, although it can provide insight into a fund's historical stability or volatility. Risk increases with fund volatility. The crucial decision lies in choosing between outperforming the market or mirroring its performance, known as active or passive management of mutual funds. Actively managed funds are overseen by professionals who conduct market research and make purchases aiming to outperform the market. While some fund managers may succeed in the short term, consistently outperforming the market in the long run is challenging. Passive investing, on the other hand, is gaining popularity due to its simplicity and potential benefits. Passive investing generally entails lower fees compared to active investing. If you're looking for an affordable and tax-efficient way to access various asset classes, investing in ETFs, exchange-traded funds, could be an ideal choice. ETFs are funds that trade on exchanges and typically track specific indexes. When you invest in an ETF, you gain exposure to a diversified portfolio of assets that can be bought and sold during trading hours, thereby potentially reducing risk and aiding in portfolio diversification. Emerging market ETFs focus on investing in securities from developing nations that undergo rapid societal transformation and have low revenues. The Morgan Stanley Capital International Emerging Market Index, MSCI, serves as a reference for identifying emerging nations. Emerging market ETFs offer a wide range of markets to choose from. If you anticipate profit opportunities in a particular nation or region, investing in an emerging market ETF can be a prudent decision. For a more targeted approach, you can consider broad emerging market ETFs that concentrate on specific geographic areas, providing you with some level of consistency in your investment strategy. Foreign direct investment, FDI, refers to the ownership stake held by a foreign investor, business, or government in a foreign company or project. It often involves the acquisition of a significant portion or complete ownership of a foreign company to expand operations into a new region. However, it typically does not refer to stock purchases in individual overseas firms. FDI plays a vital role in global economic integration, creating enduring connections between economies. Businesses or governments seeking FDI typically target open economies with a skilled workforce and above-average development potential. Minimal government regulation is often valued in these cases. FDI goes beyond capital expenditures and may also involve the provision of management, technology, and resources. A key characteristic of FDI is the establishment of effective control or significant influence over the decision-making of the foreign company. Examples of FDI include opening a subsidiary or affiliate abroad, acquiring a controlling stake in an existing foreign business, merging with another foreign company, or forming a joint venture. According to the Organization for Economic Cooperation and Development, OECD, an FDI requires a minimum ownership position of 10% in a foreign-based company to establish a controlling interest. However, the description is not strictly limited to this threshold, as holding less than 10% of voting shares in a corporation can still result in effective controlling influence. A multinational corporation, MNC, also known as a transnational corporation, is a company that is registered and operates in multiple nations simultaneously. Typically, an MNC has its headquarters in one country while wholly or partially owning subsidiaries in other countries. These subsidiaries report to the corporate headquarters. Establishing a multinational corporation offers several advantages for a business, including expanding market share and achieving vertical and horizontal economies of scale through increased output and streamlined management. While cultural differences can pose challenges when setting up offices and manufacturing facilities globally, technological expertise, experienced personnel, and proven business models can often be transferred across nations. However, multinational corporations are often criticized for being instruments of foreign dominance in the economic and political realms. Developing nations are particularly vulnerable to economic exploitation, as their economies heavily rely on a few exports, often basic commodities. Potential risks for host nations include monopolistic practices, human rights violations, and interference with established economic growth strategies. Multinational companies, MNCs, are distinguished by their substantial fixed investments abroad, which can involve manufacturing facilities, storage facilities, transportation and communication infrastructure, mining operations, or agricultural ventures. MNCs are more than just companies with local or regional sales offices overseas. A global depository receipt, GDR, is a type of depository receipt that represents shares of foreign corporations. These depository receipts are issued by depository banks on international markets, often in Europe, and made available to investors globally, including those inside and outside the United States. While some GDRs are denominated in euros or British pounds, the majority are denominated in US dollars. Similar to domestic equities, GDRs are traded, cleared, and settled on various stock exchanges such as Singapore, Frankfurt, Dubai, London, and Luxembourg. Typically, GDRs are initially offered to institutional investors in private placements before being publicly traded. An international depository receipt is a financial instrument that represents shares of a global company. The depository bank or custodian holds the actual stocks underlying the GDR. While shares of a foreign company are traded primarily in the country where the company is headquartered, foreign investors can purchase these shares through GDRs. GDRs allow companies to raise capital from investors in different countries, with the GDRs being denominated in the currencies of the investors' home countries. As tradable certificates, GDRs can be listed on multiple markets, providing arbitrage opportunities for investors. In Europe, GDRs are often referred to as European Depository Receipts, EDRs, when European investors trade shares of non-European companies locally. In conclusion, exploring investment opportunities outside of the US and UK can be highly profitable but also entails risks. Understanding the economic and political conditions of the chosen country is crucial. As an investor, it is important to focus on objectives, costs, and potential returns while considering risk tolerance. By carefully managing these factors, you can maximize your investments outside the US and UK. Thank you for watching, have a wonderful day, and I look forward to seeing you in the next video.